Good morning, everyone. We are the energy sector. My name is Kevin.
My name is Jacob Montalez.
My name is Crystal Banda.
My name is William Resendez.
My name is Carlos Castorena.
My name is Victor Ponce.
My name is Kosi Obedozier.
Again, we're the energy sector.
So we projected a buy recommendation from the current price of Marathon right now, trading at $59.50, and we believe that it has a 17.11% upside to our projected target price of $69.68.
A little bit about Marathon's operations. 40% of its business is focused in refining. So Marathon, after the blockbuster acquisition of Endeavor, became the largest U.S. refiner in terms of production capacity at over 3 million barrels of crude oil per day in production. The majority of its business, 44% to be exact, is centered around the midstream category, which is centered around the transportation and storage of crude oil products and equipment. And then last but not least, the retail space. So Marathon, 16% of its business is focused in the retail space. They are the nation's second largest company-owned and convenience store chain operator in the country, right behind 7-Eleven. And this differentiating factor makes Marathon such a unique company in its sector as opposed to all of its competitors, because they are exposed to an entirely different stream of cash flow from their merchandise sales from their retail operations that their competitors are not.
Now moving into the macroeconomics view, given that Marathon is the #1 regional refinery in the United States, they are in a prime position to take advantage of two key events that just recently happened. The first thing is the lifting of the 40-year-old national export embargo ban by the Trump administration in late fiscal year 2017. The other key event is the expiration of the 7-year ban by the Obama administration of deep sea drilling oil in the Gulf of Mexico. The first ban embargo was put in place in 1973 by the Nixon administration. This ban was put in place due to the oil embargo by the OPEC member states on the United States for supporting Israel in the Yom Kippur War in 1973. The Gulf of Mexico drilling ban by the Obama administration was put in place by the Obama administration after the BP oil spill in order to allow the environment to regenerate and allow marine life to thrive before we are able to go back in there and pump out as much crude oil as we can. Marathon Petroleum is in the prime position, being that they're the #1 refiner, to take advantage by these two things in order for them to be able to pump out as much crude oil from the Gulf of Mexico as possible. Moving down south past the equator to Venezuela, UN sanctions of Venezuela created a shortage of U.S. crude, sour crude for U.S. refiners. This affected everybody except Marathon Petroleum. Marathon Petroleum actually positioned themselves in a key position because they actually switched over from Venezuelan heavy crude to Mars heavy crude, which is sourced from the Gulf of Mexico, 3 to 6 months before U.S. sanctions kicked in on Venezuela. This gave them a key power against other refineries because they were allowed to meet demand that Valero and Phillips 66 lost, and they were able to take over market share that both of those other refiners lost in the United States. Another also developing in the Gulf Coast is spot terminals. They are proposing to construct and own a deep sea port terminal in the Gulf of Mexico. This will add approximately 2 billion barrels per day of export capacities just in this facility to United States export abilities. On top of that, we also have the Carlyle Group. They have secured a 50-year land lease in Corpus Christi. This facility is also another deep sea oil exporting terminal. This exporting terminal will add an additional 2 million barrels per day of exporting abilities to the United States on top of the already existing infrastructure.
Moving on to the IMO 2020 regulation. What this regulation is, it's a regulation that's going to be enforced by the International Maritime Organization. What they are is a subsidiary of the United Nations in charge of regulating shipping worldwide. Now, what this regulation is specifically stating is that oil companies worldwide are going to have to start reducing the carbon emissions that their ships are emitting into the environment when they're out at sea exporting and importing oil into the States. And the way these companies are being asked to do this is by reducing the amount of sulfur content in the fuel they're using to power their ships from the current rate of 3.5% sulfur content in the conventional oil they're already using down to 0.5%. Now, how this benefits Marathon as a company is that this is going to increase demand worldwide for low sulfur content and alternative fuel sources like low sulfur diesel and hydrogen gas. The way Marathon, being as ahead of the curve as they have been, in 2017 they started production on a Garyville, Louisiana refinery down in the Gulf Coast to capitalize off this surge of production that's going to come in the Gulf Coast in the coming years, like the way Will had just mentioned. At this specific refinery, what they're doing is they're enhancing their coking capacities. They're building cokers, also known as coking facilities. What these are, they're a special kind of refining towers and equipment that specialize in converting high sulfur content oil into low sulfur content oil, so that way they can take advantage of the conventional oil supply they already have. And also they're increasing their production capacity of hydrogen gas. They're also utilizing their midstream services by having other companies buy into using their midstream services to store their own hydrogen gas. The IMO 2020 regulation was announced that it was going to be enforced on January 1st of 2020. Now, this announcement came out in September of 2018, so that's really only a 1 year and 3 month timeline to announce to these companies so they can start implementing these environmental changes into their business models. Now, a lot of our smaller cap competitors in our sector have been very hesitant to implement these investment changes into their business models because, as you gentlemen might imagine, producing low sulfur content oil is a lot more expensive. And so, being that there may not be in a financially capable position of implementing these changes in time, being that the timetable is actually very unrealistic, being that coking facilities alone take many years to build and up to $1 billion to build one facility. So that, I think, gives us, as far as our buy recommendation, gives Marathon a complete advantage over their competitors in their industry. They have the largest, again, production capacity to capitalize off these macroeconomic movements and really, leave their competitors in the dust when conventional oil prices like WTI and Brent maybe come down during economic recessions, where these other competitors rely on these high oil prices, whereas an oil giant like Marathon would not.
So, of course, we have to look at the competitor's stock price. So what we did here, we have a graph going back to 06, 2014, all the way to 04, the beginning, the first of this month. The average median beta for these four competitors, and what we chose on was on market size as well as their geographic location to their competitor, Marathon. And what we chose was Holy Cross Frontier, Phillips 66, as well as Valero. And their average beta for that was 1.1675, just slightly over the 1% that we all know as the average for the market for volatility. We see that both Marathon as well as Holy Cross Frontier were both high in volatility 2014, but of course we know that was due to the recession. Going into the second quarter of this year for 2019, we see that Marathon is proving itself to be a very more of a safe stock to invest in the long run. Also, we have here are the debts for the 2018, the fourth quarter of 2018. This isn't as of the first quarter yet, just because those financials are coming out in May 8th of next month. But what we see here is that they had made large consolidations of their debt from the acquisitions of companies such as the logistics side of Marathon, as well as Endeavor. And that consolidated debt would equal to $27.5 million around.
When analyzing Marathon's revenue, we computed a CAGR of 6.20%, and that's mainly derived from their strategy of mergers and acquisitions that's given them the opportunity to grow from how they have been in the past. When forecasting the revenue, we use a combination of growth rates, and the reason being is because the company's still growing and they haven't had the consistent revenue. In addition, we also wanted, the reason for having a volatility trend within their revenue is because they are an energy company, and energy companies are highly correlated with commodities which are volatile. For 2019, we're forecasting Marathon's revenue to be good, but then decrease and end strong in 2023. For the oil price forecast, we had two crude oil commodities to choose from, which is Brent and WTI. But for our oil price forecast, we went with Brent because they have a higher correlation with Marathon's revenue. And the drivers that came from the oil price forecast from Brent is the Marathon's annual revenue and the impact of price, which is derived from two revenues, the total vehicle miles driven and the Brent average annual price. And as you can see, the oil price forecast is volatile, which is what we were also trying to do for our revenue forecast.
When selecting Marathon's investment risk factors, we consider the risk factors presented in their annual report in their 10K. These encompass the financial, operational, legal, strategic, and market risk factors. Amongst these are Endeavor's acquisition. And Endeavor's acquisition with Marathon's acquisition of Endeavor poses significant risk factors in terms of mergers and acquisitions, because the company will take on consolidated debt from Endeavor, which could significantly increase the costs of their capital expenditure in the future. It also poses inaccurate assumptions concerning their earnings per share, their cash flows, as well as changes in the economic and financial conditions could lead to an increase in the capital expenditure for Marathon moving forward, provided that these assumptions about the market do not change. The significant costs incurred by Marathon considering the Endeavor acquisition can also lead to increased transaction costs, costs of implementation, as well as decrease in the reduction of their facilities, because they're taking the existing oil refineries and production facilities for both Marathon as well as Endeavor and consolidating them to increase their efficiency. Marathon could also face significant costs, significant expenses, provided that their credit profile does decrease in the future if their financial conditions do not change, as well as their income and revenue. In terms of energy production, the energy production faced by Marathon as well as their recent acquired facilities from Endeavor could also directly impact their revenue as well as their ability to distribute to most of their firms.
For our valuation method, we use a perpetuity growth discounted cash flow model. To get our weighted average cost of capital, we use the capital asset pricing model to get to a WACC of 10.7%. With our long-term growth rate of 7% and our WACC of 10.7%, we achieved our target price at $69.68. With that being said, we believe the company has a 17% upside from its last closing price. And out of our entire sector, we believe that this is the most uniquely undervalued company, and it's even more unique that they're based in San Antonio. So, that's it.
Question?
Questions?
Can you go back to the previous slide, just so keep it there? No, I just wanted to see it. I'm looking through them, making sure everything makes sense. Go for it.
So I have a question. You walked through the industry analysis and indicated that Marathon was an industry leader. And then you articulated really well how the Endeavor acquisition would make them the industry leader. They weren't one before. And then the opportunities, IMO and others from the Trump rate change in regulation. You put that all together. How did you think about, or did you have a chance to think about it, realize your time constrained about it? The opportunity? I mean, you spoke to the risks about the merging of these two large companies, but there might be expense or other revenue synergies that come out of that, which might affect this kind of cash flow analysis and sort of the growth rate. It might create an opportunity for the growth rate to be higher than history. And how did you think about that, if you did it at all?
Okay, so we used a 7% kind of conservative,
Okay.
partly because we kind of see a recession in the near future and a slowing of, world growth is kind of coming to a slowdown. And so now that the US is kind of starting, we're kind of at the peak, right? We kind of forecasted that, revenues will definitely fall within at least another year or two.
Okay.
So with that being said, and given the cyclicality of energy companies, we decided to be more conservative in our forecast. So we just kind of played it safe with the 7% growth rate.
Okay, so one way to think about it is you think it's undervalued as 11-12% upside, but if a recession doesn't happen and there's really good synergies from the acquisition, that upside would be greater than what you're modeling.
Yes,
So
sir.
it's sort of- Okay, thank you. Paul, I got another one.
You got another 5 minutes.
Oh, I got another 5 minutes, I don't wanna dominate here. Any, how do I phrase this question? You did, a regression analysis, it looked like, to compare Marathon to the other companies. Did you, and you did a lot of work on industry and financials and quantitative, qualitative for Marathon. Did you do any of that for Valero or Holly or Phillips or any of the ones that you looked at to say, okay, did a regression, here's what it is, but we looked at the opportunities and risks in the industry, the business model for the other companies. Did you have any time?
We did look at Valero.
Okay.
We didn't do any discounted cash flow analysis on them, but we did look at their ratios since Marathon and Valero are kind of similar in their
Okay.
size, and they were both great companies. The thing is with Valero, they're more exposed to the Venezuelan prices, whereas Marathon wasn't. So, and given that the stock price was a little bit cheaper, we thought it would be more upside for the ICDI portfolio. So that was kind of our reasoning to just stick with this company over Valero.
If you had more time than you had, I know Professor Sweet has indicated that sort of time constraints you have, but you have a lot of other academic duties and personal lives. So what, if you had more time, what would you think about doing to buttress the analysis that you did?
I think if we had more time, me personally, I would like to do a little bit different modeling. I know there's specific oil and gas modeling, net asset values and some of the parts. So we just kind of kept it simple with the discounted cash flow since it's kind of a very vanilla model. That's what I would like to do. I don't know about you guys.
Yeah. The same.
Right, we had discussed, maybe pursuing different financial models. We even considered forgoing the regression and maybe adopting a whole new different prior method of income as opposed to our regression as well. But once we went on through our semester, throughout our weekly meetings and our work sessions, and we just decided, getting a regression for all these companies in the industry would probably be the most efficient way for our time. We could really value and trim down the number of companies we were thinking about pitching to you guys today.
I would have considered a different comparative risk assessment for the leading industry competitors, leading industry corporations within the oil and gas industry.
Any other questions? All right, thanks.
All right, thank you.
Thank you guys.
Thank you guys so much.